What's up, you guys? My name is Aubrey and this is my channel, and today we're going to be talking about the basics of investing, more specifically why you should invest and what the difference is between investing and traditional savings, and also how to get started with investing. Over the last few months, I've been getting more and more requests from people on creating content around the basics of investing, really starting from ground zero and then going up from there. So that's something that I want to start incorporating on this channel on a regular basis, instead of jumping into the complexities of investing, really starting from the beginning and walking you through the process of investing from A to Z. So in today's video, we'll start on ground zero and talk about why you should invest and how to get started. Now, before somebody starts investing in the market, I think it's important to understand the difference between investing and savings and why there is such a big benefit to investing a portion of your income each and every month. Now, the average American savings account has an interest rate of 0.01%. Now, there are obviously ones that have significantly higher interest rates than that, but the American average is 0.01, which means that if you deposit $50 every single month into a savings account for 30 years, at the end of that 30-year period, you will have $18,026.19. Whereas on the flip side, the stock market has an annual return on investment of 7%, meaning that every year you can expect on average to receive a 7% return on your investment. Now, again, of course, there's years where this is lower and there's years where this is higher, but that is about the historical average, which means that if you were to do that exact same thing, if you were to invest $50 per month every single month for 30 years into an investment account, at the end of that 30-year period, you would have $60,998.55. You are investing the exact same amount of money over the exact same period of time, but with an investment account, you're making over 3 times more than you would if you were putting that same money into a savings account. And in my opinion, I think that that comparison really shows the power of investing and the power of how great this is as a tool to grow your wealth. So now that you know the importance of investing versus traditional savings, it's time to open up your brokerage account. Now, a brokerage account is simply a platform where you can go and buy stocks and facilitate your trading investment portfolio and make trades and see how much you've grown. It's basically a bank account, but for investing. Now, there are a lot of different services out there that exist for this reason. There is TD Ameritrade, Charles Schwab, there is app-based platforms like Robinhood or Webull. There are literally dozens of choices out there. And in my opinion, I think that all these platforms are extremely similar in what they do. And really, if you're a new investor who's just wanting to get your feet wet in the world of investing, I would encourage you to choose a platform that is easy for you to navigate and not pay too much attention to the nuances of each platform. For a new investor, ease of use and accessibility are the two most important things, because if a site is hard to navigate and hard to understand, you will simply just never invest your money and you'll avoid it altogether. For me personally, I think that TD Ameritrade and Webull are two great platforms to get started with. TD Ameritrade is more on the professional side of investing. It's definitely considered more of a traditional platform that seasoned investors use to some degree. It is a really easy to navigate site. It's easy to use, it's easy to sign up with, but it also is something that could be intimidating to a brand new investor. So if you're somebody who's looking for something a little bit less intimidating, then Webull is an excellent option. Webull is another account that I personally use, and I love Webull, one, because it's app-based, so it's super easy to navigate on your phone, and two is it's super easy and intuitive to use. The other great thing about Webull is I have a referral code with them, and so if you sign up using my referral code, then you get 2 free stocks, and it is real, you actually do get free stocks, and so that is a huge bonus of Webull as well. But again, it ultimately doesn't matter which platform you choose, it's just a matter of choosing one that you feel comfortable with and that you feel confident in using on an ongoing basis. So now that you know why you should invest, you know how to start investing, now begs the question of where should you put your money? And this is a question that is so much easier said than done. And this is where so many investors get stuck because they don't know where the heck to start and where the heck to put their money. And so with that, I think that a great option for new investors, especially for an investor that's just trying to get their feet wet, is to look into funds. Now, there are kind of 3 main type of funds. We have mutual funds, index funds, and ETFs, or exchange traded funds. Now, these 3 types of funds and the definitions of each one and the differences between them can get extremely confusing extremely quickly. So I will try my best in this video to explain it in the most easy to understand way as possible, but I'm sure I'll oversimplify some stuff in the process. So basically what a fund is in its most simplest form is an accumulation of stocks and investments that represent a wider variety of the market. For example, instead of buying an individual company like Tesla, where you are buying in Tesla, you're buying the performance of Tesla, you're buying the outlook of Tesla, and all that matters is Tesla's performance. With a fund, you are buying that one fund, you're buying one share, but instead of it just being represented by one single company, it's represented by a dozen different companies in a dozen different industries. The benefits of funds versus traditional stocks is, one, it's considered a safer investment because, back to the Tesla example, is if you invest in Tesla and then you found out that Tesla was filing for bankruptcy tomorrow, that stock would absolutely tank and you would lose a crap ton of money in the process. Whereas with a fund, if one of those companies in that fund end up filing for bankruptcy, yeah, it probably would have an effect on the fund as a whole, but not anywhere near as significant as it would if you owned one individual stock in a company. So it's often viewed as a significantly safer investment because of the fact that it's so diversified. The other benefit of a fund is that they are traditionally managed by professional management companies. For example, Vanguard is a very well-known management company that has a variety of different funds that they manage on the market. Because of this, you have professionals that are managing these funds. They're deciding what companies go into these funds and what these funds are going to be doing on a year-by-year basis. And because of that, it kind of means that you have a professional management company on your side assisting you manage your investment portfolio. This is great because it allows for you to kind of put your investments into your professional's hands rather than having to learn all of these things on your own from the very beginning. So it's a great way to put your money in the market without going in blindly and just hoping for the best, because you know that if you're buying into a fund, it's professionally managed and these people most likely know what they're doing. The other thing about a fund is that there are multiple types of different funds, and I will go into kind of the nuances of that in probably a later video, as I could go on for hours today going into it. But there are different funds that serve different purposes. There are mutual funds which are designed to mimic an industry or a segment of the market. For example, you could have a fund that is set to mimic the oil industry or a fund that is set to mimic the tech industry. Whereas an index fund is a fund that is set to replicate another index or the market as a whole. For example, you guys have all heard of the S&P 500. It's a widely known segment of the market. There is the Vanguard S&P 500 index, which is an index fund that was created to mimic the performance of the S&P 500. So there are a lot of funds that exist out there that are an accumulation of a variety of different stocks that are set to mimic a different segment of the market. Now, I know that this is incredibly confusing and it's extremely hard to simplify it in an easy to understand manner. But basically what I'm saying is that if you're a new investor and if you're somebody who's just wanting to learn about investing and invest your money in the process, then I think a mutual fund, an index fund, or an ETF are really great options to go down. All of these are extremely similar. There's differences in between the way that you buy them and the fees associated with them, but for the most part, all are great options to explore if you're somebody who's a new investor who's just wanting to get started. Now, I will leave my explanation of funds to that because I know that I probably didn't do the best job explaining this in a simple form, and there is simply too much information out there to be able to simplify everything in this video. So I will probably do individual videos in the future talking about all three of these funds and the differences of them and the benefits of them. But overall, I just want to get the point across that if you're a new investor and you're wanting to get involved in the stock market, funds, whether it be a mutual, index, or an ETF, are great ways to get started in investing with a relatively low risk. But I would love to hear what your thoughts are on this video and any questions that you may have on investing. I will definitely plan on making more videos like this in the future, and we can kind of build off of each video week by week so that we can all gain investing knowledge together. But I would love to hear your thoughts, so make sure to leave a comment. And while you guys are at it, make sure to hit that like button, hit that subscribe button, hit that notification bell, and I will see you guys in the next video.